The market looks strong, but the strength is dangerously narrow. If you are chasing chips after the move, welcome to Dragon Bullion. Here is the market signal for June 26, 2026. It is a semiconductor-led market. KOSPI can go and look firm. US equities can look okay. It is crowded into the companies tied most directly to AI hardware, memory, and data center infrastructure. Samsung Electronics. That does not mean everything with an AI label deserves fresh money. The key distinction is leadership versus entry price. A stock can still be a good long-term asset and still be a poor short-term entry if the move has become too crowded. The practical call is this. Do not chase the chip rally blindly. Manage position size. The first warning is breadth. When only a handful of semiconductor names carry the tape, that is why many investors can watch the market rise and still feel like they are not making money. In Korea, Samsung Electronics is still important because it anchors Korea's AI memory story. It is selective. The same idea applies to the US market. Semiconductor strength does not automatically mean the Magnificent Seven are healthy. M7 has already absorbed a lot of pressure. Money has moved from the broader mega-cap AI platform trade into hardware and memory names. That is a late cycle looking rotation inside the AI theme. Early in the cycle, investors pay for infrastructure and scarce hardware. Later, they start asking whether the customers of that hardware. That is where the next risk begins. The second warning is margin pressure. If memory prices rise, that is why Samsung Electronics, SK Hynix, their product price improves. Their earnings estimates can move higher, but every seller has a buyer. The companies building AI services, if they can pass the cost to customers, the cycle stays healthy. If they cannot, a strong chip price is not always bullish for the whole AI trade. It can also signal that the cost of building AI is rising faster than AI revenue adoption. When that gap opens, the market starts questioning the spending cycle. The third signal is M7. That matters because the next major AI profit pool, AI hardware, was the first winner. But once that infrastructure exists, the real question becomes, that is why M7 cannot be ignored. Apple, Microsoft, Amazon, Alphabet. If AI software revenue begins to show up more clearly, the timing is the issue. The cleaner trade is to wait for price levels where the risk is better. The fourth signal is rates. Companies financing AI infrastructure do not live only in press releases. They live in the credit market. If treasury yields rise, the cost of capital rises. If the cost of capital rises while chip prices are also rising, they pay more for hardware and more for financing. That is why Nvidia is still a central confirmation point. Nvidia demand tells us whether the AI capex cycle is still alive. US market rates tell us whether that capex cycle is becoming more expensive to fund. WTI also matters because oil inflation can keep rate pressure alive. So, the market filter. The better question is, if the answer turns into no. For Korea, the dollar-won exchange rate is the macro warning light. The Korean won currency has already weakened sharply from the lower 1,300s area into the 1,551 breakout zone. That matters because a weaker Korean won currency can support exporters in one way. A stock market rally with a weak currency can happen. Domestic money can move from deposits into equities. Local investors can chase yield while the currency stays under pressure. But that structure has a limit. If the dollar-won exchange rate pushes above the 1,550 zone and keeps moving higher, foreign investors can become more defensive. Policymakers may shift attention from asset prices. That is why the Korea trade needs two confirmations. Second, if chip leadership stays strong, but the $1 exchange rate breaks higher again, crypto, Bitcoin, and Ethereum can still be watched for price buying opportunities. The reason is simple. When market money is crowded into chips and AI hardware, Bitcoin can lag. Altcoins can stay weak even while semiconductor shares look strong. A healthy, broad risk-on market usually has better participation. When crypto is weak and only a narrow semiconductor group is strong, for crypto positioning, do not chase altcoins just because they bounce for a day. Wait for stronger volume, better liquidity, and a more stable $1 exchange rate backdrop. The buy plan is not complicated. First, if you already hold strong leaders at good prices, manage them. Second, if those two leaders hold up better than the index after a pullback, if they fall with the index and lose turnover. Nvidia gives the global AI capex signal. Micron gives the memory demand signal. If those confirmations stay healthy. Fourth, a stable Korean won currency. If those three move against the market at the same time, cash is a position. The reduce plan is just as important. Reduce exposure if the semiconductor leaders stop leading while the index is still pretending to be strong. That is usually how narrow markets start to break. Reduce if the $1 exchange rate breaks above the 1,550 zone. A weak Korean won currency does not automatically end the stock trade. Reduce if US yields rise. That would hurt the customer side of the chip cycle and can eventually feed back into supplier expectations. Reduce if Bitcoin and Ethereum keep weakening while altcoins are being chased only on short-term hope. That is not leadership. Most of all, reduce if you find yourself buying because you feel left behind. It is paying a narrow group? Here is the market core. Samsung Electronics. The next cleaner opportunity may come from M7 and AI software. That does not mean buy M7 immediately. For now, the checklist is clear. Watch KOSPI breadth. If chip leadership cools while FX and rates stay calm. If chip leadership breaks while the $1 exchange rate and yields rise. Good investing here is not about proving you are brave. It is about protecting cash,